Although bonds have several advantages, these are two of the main ones. The biggest advantage of investing in bonds is that there are very less chances that you will lose out on your investment, and when compared to other safer forms of investments, such as saving accounts in banks, bonds pay a much higher rate of interest. As anything is perfect, bonds also have some disadvantage. The foremost disadvantage of bonds is that when compared to shares, gold, and real estate, the rate of interest that they generate is very less. Another disadvantage of bonds is that there is always a risk of the company which has issued the bonds going bankrupt.
Moreover, there are some financial institutions that participate in the bonds market. First, commercial banks and savings and loan associations. They participate through bonds for their portfolio of assets. Sometimes they place municipal funds for the municipalities, and they issue bonds as a source of secondary capital. Secondly, financial companies. They usually issue bonds as a source of a long-term funds. In the third place, the mutual funds use funds received from the sales of shares to buy bonds. Some mutual funds with bonds specialize in particular types of bonds, while others invest in all types. The brokerage firm facilitate operations with bonds because they relate buyers and sellers of secondary market bonds. In the fifth place, investment banking signature place newly issued bonds by government and corporations. They can place the bonds and take the risk of an uncertainty about the market price, or they place the bonds according to the best option without guaranteeing a price to the issuer. Finally, in the same way, insurance companies and pension funds buy bonds for their asset portfolio.
What is bond valuation? Bond valuation is a technique for determining the theoretical fair value of a particular bond. Bond valuation includes calculating the present value of the bond's future interest payments, also known as cash flows, and the bond's value upon maturity, also known as its face value or par value. A bond is a debt instrument that provides a steady income stream to the investor in the form of coupon payments. Bond valuation, in effect, is calculating the present value of bonds' expected future coupon payments.
Thanks to you, now I know that I have to loan a money to the user, and at the end of the period, the bond value has to be repaid.